Hey everybody, welcome to the morning market briefing. It's Tuesday, July 14th, 2026. Hope you're doing well out there. Ben, Tom, how we doing?
Feeling good, feeling strong.
All right.
Big day.
Big day. Lots going on. Let's jump in with inflation fears. Trump now proposing a 20% fee on the Hormuz traffic as he reinstitutes the blockade. Listen to a little bit of commentary on there. There seems to be a decent amount of uncertainty on how this would actually be done, how it would be applied. Interestingly, seems like more people wondering how it's going to get done than wondering if he can do it. But you think of the apparatus in which you would have to, I guess, board ships and see what they have and value it and slap a fee on it and collect it and all of that.
The inflationistas are
They're
gonna love this, though. Yeah, I know that they need some good inflation fears today. The Fed's Waller, who was actually one of the people in the running to become the new Fed chair, was warning about potential for higher inflation, and they really want some higher inflation. I don't know if I think personally, this is my tinfoil hat theory. Iran is adamant that they're going to charge fees. Trump understands that. He also understands that he doesn't have the cards. This is how he gets leverage, is that he says, we're going to charge a 20% fee, and then when they come back in, a couple weeks, we negotiated down to 5% fee, and we're going to split it with Iran.
Yeah. It kind of makes sense. It's interesting to me that it seems that both sides are now just deploying new tactics with the Strait. And not new. I mean, we've seen them obviously during this conflict. This is not the first time Iran has exercised control over the Strait. It's not the first time Trump's tried the blockade thing. But it seems like, by and large, if you're the world and you're just out here listening, I would argue that, hey, all we're really just seeing out here is just new ways to tax goods. And maybe we should think about that and think this might not be the most sustainable long-term resolution after all. Tom?
Because inflation's so bad right now.
Yeah, let's talk about it.
Man, so I was thinking literally as I was walking down today, I was looking at rates before we walked over here, and I thought, man, maybe I was just completely wrong. The 30-year has risen all the way to a 5.10. I was like, but I feel like inflation is not as high as it has been. I feel like the idea that they're going to hike is not nearly as real as people are saying it is. I mean, yesterday, Chris Waller had an all-time weird interview where he was basically saying, yeah, if inflation is hot tomorrow, we're definitely going to hike. A hike is on the table. The bonds were selling off like crazy. He also said, I'd have to look up the exact quote, but he butchered a classic line, which is, I don't know what obscenity is, but I know it when I see it. And what he literally said was, I don't know what pornography is, but I know it when I see it, which is an actual quote from someone who's on the Federal Reserve. And I was like, I bet you do. Yeah. I bet you do know.
That actually seems quite simple to define.
Yeah, it's like what he meant to say was obscenity. What he did say was pornography. So,
yikes, dude. Yeah, chill out, bro.
TK asked me about it. He's like, "Do you see this thing about Chris Waller with the pornography thing?" I was like, "Well,
I'd actually prefer not to see the pornography."
Let me teach you a little bit about the obscenity laws of the middle 1900s when we were trying to determine what is and isn't supposed to be in real society. But rates are crashing at the moment. So CPI was expected. Little tangent there. Who thought that's what we were going to talk about today? So expectation was for month over month to be down 0.1, core to be up 0.2, the year over year to be 3.8, and the core year over year to be 2.8. And I hate to break it to the haters and losers once again, but month over month, core CPI headline number came in negative 0.4%.
It's a big negative.
Yeah, core CPI month over month came in at a big old goose egg of 0. The headline number is 3.5%, and core CPI year over year came in at a blistering 2.6%.
And by the way, the 3.5 on the headline is down from 4.2 last month.
Yeah. And I mean, it's pretty much what we thought it would be. I mean, inflation continues, especially on what was the Federal Reserve's choice piece. The core piece is coming down fast, and it's getting very close to 2. Just kind of breaking through the data, though, things that have been sticky and concerning to me in terms of their readings: transportation services down 0.3%, shelter, which continues to run at an annualized rate of 3.3%, which, again, fake news, finally came in with a number that is somewhat reasonable at 0.1, which, if we can hold a number like that, will bring that number very
That's going
quickly
to bring things down quickly.
Yeah, because the annualized on 0.1 is going to be 1.2%. Apparel down 0.6. You're seeing a little bit of weakness in both new and used cars coming down. So, I mean, a lot of the things that have been real sticky or worrisome, that's where you're seeing the biggest moves, month over month. And then, of course, energy is cratering, down basically 9.5%, depending on where you look, which should be expected.
On a core year-over-year basis, though, energy is still up 15.7%. So that's still lifting that headline number. I mean, if I look at the core numbers, here's what I have. I have new vehicles up 0.5% year over year. I've used vehicles down 1.8. That's deflation. I have apparel that's still up 3.9, but just deflated 0.6% month over month. I have medical care commodities down 2.1, and it's really just services, and a lot of that has to do with the shelter component, and a lot of it has to do with transportation services, which again deflated in each of the last 2 months. So as I look at this, I'm thinking the path of least resistance for inflation continues to be downward. We've been pretty consistent in that, and if you look at the chart of the CPI, this is what transitory is. This is the definition of transitory. And people are still fixated on, no, if you print money, that's transitory. And printing money creates permanent inflation, and oil shocks are transitory.
I mean, I would also, and we got real average weekly earnings numbers. It came in at 0.3%, but last month was revised down to negative 0.5% from 0.4%, and then real average hourly earnings year over year up 0.1%, and then also last month revised down 0.1%. So we're not seeing wage growth either, which was a big piece of COVID inflation. Was everybody was seeing wage growth? So
checks in the mail.
We don't have strong wage pressure on inflation. We do have it on energy, but that's cratering very quickly. And then all of the big sticky pieces are, if they're increasing at a lower rate than they were before, which we're coming up against pretty difficult comps. I mean, if you look back to December, we saw shelter up, 0.4, 0.2, 0.2, 0.3, 0.6, and now we're seeing a 0.1, which I think is the only realistic number we've seen all year.
That's not going to move.
Yeah.
Like that's going to stay pretty much at 0.1, because that's the nature of how it's calculated, is that it's not going to move around a whole lot, which means that pressure for inflation has completely been relieved and is now going the other way.
On the housing component, one comment I would make, just if you're a newer listener to the podcast or viewer on the YouTube, if you're not a viewer on the YouTube, what are you doing? You need to subscribe and like it. But we bemoaned the housing data when inflation was very high in 2022, because it does tend to move very slowly and very much at a lag. So when we had high CPI prints, 3 or 4 years ago, the reality is they probably should have been higher given what was happening in the housing market. So there's a two-sided coin. You've heard us frequently in the last 6 months talk about how the housing number is bogus. There's no way, the shelter component is actually going up at the level that they're saying it's going up. Once it starts to go down, it's going to go down, and we may ultimately at some point enter a cycle in which housing prices actually are going up and rent is actually going up, but this is not showing yet.
And one thing, we haven't talked about it on the podcast, but the Federal Reserve released a paper last week that basically said, regardless of what the number actually was on illegal immigration during the Biden administration, that the influx of new populace combined with the amount of money being, basically the checks being cut from the government, caused housing inflation to rise 30%, and it had a decreasing effect on wages. So we've talked a lot about what is a pressure that could bring down inflation. Well, one is the fact that we're not bringing in new people right now, and that can at least at one point stabilize things. But what you're probably going to see is a flip, which is you're going to see as new jobs start to open up and there are fewer bodies who are willing to take less money than Native Americans, not indigenous peoples, Native Americans, there's a difference, and willing to take those jobs, you're probably going to see inflation come down quickly because housing is going to subside quite a bit because the demand for homes, which are being paid for by the government, is going to drop off quite a bit as people return to their homelands, and as people start to get real jobs paying real wages, and
or even if they just
pay
stop,
for actual rents.
even if they just stop coming.
Yeah, just the fact they haven't come.
I am sure there's someone out there listening now and would say, "Oh, well, the deportation numbers are only this." It's like no, but the shock to the system was how many came in without additional housing.
Yeah, if you have 10 homes and you
additional
had
jobs
100 people, eventually you could build enough homes to house those 100 people, whether they belong here or not. But if you continue to add more and more people, then you're never going to catch up. And there's always talk about we can't build; it's too expensive. There's not enough homes. Well, here's a great example of that. I mean, the Fed has been pretty agnostic on that and has not really made a lot of should there or shouldn't there be illegal immigration. They're saying, oh, it really helped with the hiring, but it didn't help with wages because you're hiring people with lower wages. But what it did do was shock the system with just the sheer number of people who needed to be housed. And then when you add the fact that you're paying them money from the government to house them, it causes real supply and demand problems.
People aren't really talking about that on the demand side. I think they're also not talking about a couple things on the supply side, or I think they're misreading it. Number one is what the Fed's policy is. I think that they're completely giving Jay Powell a pass for all the money that was printed in 2020 and 2021. The second thing is a lot of people have lamented the deficit, but what are these MAGA accounts or Trump accounts doing? Well, that's increasing the savings rate. We talked about it yesterday as well. What would Trump accounts essentially for adults, workers, employees that are funded by employer, basically a new payroll tax? What would that do? Well, that's increasing the savings rate. It's not money that's being given out to be spent today. Rather, it's money that's actually being intentionally set aside, and that's going to increase the savings rate. When you have higher savings in an economy, you have lower demand. Like that's just the function of it. That's classic economics, but people aren't talking about that. So to the extent that we actually do have this increase in the payroll tax come through as we looked about to fix the Social Security system, that's going to have a disinflationary impact as well. And so both on the supply side and, as Tom pointed out, on the demand side, we're seeing these disinflationary impacts. That's why I'm very confident that inflation is going to continue to go to the path of least resistance, which is downward. And it really has to, because if we don't get inflation down and we don't get interest costs down, then the debt is unsustainable. But if we do get interest expense down, if we get interest expense down to 2% again, then all of a sudden we cut that $1 billion annual bill in by half. What's our deficit right now? Maybe like 1.2 trillion. Now we're down to 500 billion just by getting the rates down to 2%.
And it's speed of change. I mean, it's not unlike the immigration thing. It's speed of change. If you're increasing the deficit at a high speed and you reduce it, then it becomes more manageable. I mean, it's interesting.
There's a lot of outs here.
I will say this is a totally random tangent, but recently I've become very aware of a YouTuber. His name is Caleb Hammer. Have you guys seen this guy?
I don't think so.
He's basically Gen Z Dave Ramsey, except that he just like openly roasts people to their face about their bad financial decisions. You should watch some of his stuff. It's awesome because it's basically, all of these things that we talk about, and he's very open about just like the deficit, how spending works, medical care, all these things, and he just absolutely kills people for their bad decisions. And I was listening to him on a podcast yesterday, and the podcast host asked him, and I think it would be an interesting question to ask you guys, but which do you think is actually having a worse impact on the U.S. economy? Is it actual inflation or is it lifestyle inflation?
It's got to be the lifestyle.
I think it's lifestyle too. But he made a really interesting point. He was like, the things that are less expensive or more expensive now than they were when your parents were raising you are not the lifestyle things. It's all the things that have almost nothing to do with capitalism, which is housing, medical care, and taxes. All of those things are much higher now than they were when you were a kid, but everything else is less expensive. So when you were a kid, it was like, oh, we need to cut back. It's like, well, you didn't buy a new TV, you didn't buy a new car, you didn't buy new stuff. But unfortunately, everybody buys stuff constantly. We become this insane consumer culture. But the things that are least affordable for people who are coming out of college now are all related to things that are managed by the government primarily, or at least highly regulated by the government, which I think is interesting, especially as it relates to the deficit. What do we have? We have runaway spending, so taxes are higher. We have poor management and regulation around housing and massive illegal immigration, and that's causing problems. And the third piece, medical care, which is just a runaway train that no one seems willing to even try to stop.
Well, and you also bring out a few points where government actively is constraining supply.
Yep.
And government's actively subsidizing that. So in housing, constraining supply via permitting and regulations, and there's a role for that, but I think that sometimes it's taken to the extreme. Education, constraining supply with accreditation, and who gets subsidies, and then in medicine, obviously massive constraints. I mean, how many people would want to be doctors? A lot more than actually get to be doctors, and I don't think that's an intelligence thing.
Mm-hmm. Let's switch gears, talk about some individual companies. Samsung, unsurprisingly to me, is exploring a share sale in the U.S., kind of just like what SK Hynix just did, potentially offering an ADR. They're talking to banks, no specific plan out yet. Would presumably be some interest in that, although SK Hynix, credit to them, first mover, so probably going to take a little bit of the oxygen out of the room. IBM down 19%. HCA down 6%. Ben, what's going on?
Now I think it's down 10%. So these companies both report earnings next week, and they're both saying we are terrible and getting this news out early. I'm interested to see if this is going to be a new trend. Usually we see warnings on the quarter happen like the first week of the quarter, not right before they report. But basically IBM saying people are reallocating CapEx budgets. IBM, for all of its talk about moving to software and more into quantum computing, first of all, quantum computing is not happening right now, even though IBM says it will. IBM is still a mainframe company, and people are moving their capital budgets from mainframes to AI, and that's really hurting their business, and they're cutting guidance massively. HCA, the big private hospital operator, they're cutting guidance. Essentially what happened is people signed up for the exchanges and the ACAs, and now they're just dipping out. So that's transitioning from ACA to Medicaid, and that's really hurting their business. It's hurting their surgery volumes, and this is going to stick with them, and I don't know how they really necessarily get out of that. And so we've been exiting HCA over the last few weeks because we kind of saw this coming.
Yeah. Some other economic read-throughs, Fastenal showing continued improvement, which I think is hopefully a good harbinger for things to come on the manufacturing side, Ben. But we also got small business optimism. How's that looking?
Yeah, so I want to talk a little bit about the overall economic growth. I think that there are definitely companies that are doing pretty well right now. Fastenal is one of them. The banks are another group that's doing quite well. But Fastenal, we don't even have to show the charts, Hicks, but we can if you want that first one. But this is a company that's a harbinger of the manufacturing side, industrial side of the economy, and that continues to accelerate. And the NFIB Small Business Optimism Survey was better than expected again as well. Capital expenditure is not moving a ton, but doing a little bit better. And I think you're seeing a little bit more enthusiasm. You're certainly seeing that from Fastenal. They're talking about, on their outlook, they say broader market conditions continue to improve as they did in the first quarter. You see that from the Small Business Survey. I think there's a lot more hope after the wars, I don't know, pretended to be over, I guess. And then there's also a deal, which I think is very relevant because we've talked a lot about, is it going to be nuclear? Is it going to be natural gas that powers these data centers? And SLB is a picks and shovels play. They provide the drilling equipment essentially for natural gas and oil and fracking. And they're teaming up with Liberty Energy, which is a fracking company, to provide natural gas power to data centers. And I think that that's a really, really good move from both of them. And it's a good, smart, intelligent way from SLB to build a little bit more stability, because natural gas prices move very, very rapidly. And this way you'll have a little bit more long-term certainty, and SLB will be able to benefit from that.
Man, can I just interject with what I will like to say is the best tweet I've ever seen?
Wow.
So Michael Green, a.k.a. Professor Plum, who's a famous economist, works for Simplify, which is an ETF company, just tweeted 1 minute ago, "The real story in CPI is the continued overstatement of shelter costs. Core still coming down. Not a popular narrative, but correct." Is he listening? Is he on the call right now?
Shout out to Professor Plum.
Wow.
Super user.
Feels good.
Ben, we're also getting earnings from the banks. Kind of mixed market reaction, unsurprisingly, to at least probably to anybody that listens on the call. Goldman up about 2%, saying momentum has accelerated throughout our business. Clients are turning to us to lead their most strategic and consequential transactions. We've certainly seen that time and time again as of late. Any other big takeaways on the banks?
Yeah, I like to look at credit quality. I like to look at credit card volume, and then obviously the investment banking volume. Investment banking volume is just ridiculous. Goldman Sachs up 55%, and obviously they take the lead, but Bank of America up 50, Citi up 45. I mean, this is a year-over-year number. It's unbelievable. On the trading side, Goldman Sachs came back after a really weak quarter last time around. They were up 32% in fixed income. So they deserve to have this best reaction. But if I'm looking at the underlying businesses for all of these companies, they're all in very good shape. Credit quality is improving. Delinquencies are way down. Wells Fargo was the weakest. They were only down to 2.58% year over year from 2.63. But
still better than a year ago.
Yeah, but JP Morgan was down to 191 from 206, and Bank of America was down to 223 from 236. So delinquencies are coming down, charge-offs coming down, net interest income going up. It's all good for the banks right now. I think they're all kind of approaching it relatively cautiously, saying things are good right now, but we want to prepare, and we don't want to. We know this is a volatile business. And so I think that's why you're seeing perhaps the reactions today. They'd also run up into the numbers. But overall, I think very good for the banks, very good for the industrial side of the economy. Very bad for anyone who sells to companies a competing product of AI stuff. So IBM getting smashed.
Man, Tim Rowe's having to eat a little crow this morning.
Man, did you see his, he said, CPI disinflates. In like with
quotes.
With quotes.
Yeah, but he put very cool prices in the June CPI across the board.
They were cool. I liked it.
Core goods declined for the second straight month. Housing was up just 0.12%. Core services ex-housing was negative 0.2%, the lowest since COVID lockdowns. So, you tell me, does that mean we need 5% on the 30-year? Are we running away? Do we need multiple hikes to just rein in this incredible runaway inflation?
I'm surprised rates aren't down more than they are.
I am. At first, they jumped quite a bit. They've sort of walked back just a touch. We got down to like a 504 on the 30-year, and we're back to a 508, which is shocking to me.
It's interesting in markets. I don't know if you guys would agree with this, but sometimes I think markets certainly actually do the opposite of what you think. When it's a fear and greed, and they overreact to scary news. And they think that good news can't possibly be that good.
Well, I think that, too, it's a bit of framing, which is like, if I come in here every single day and I'm like, this is the worst scenario, this is the worst market we've ever been in, is awful. Everything is terrible all the time. And then someone comes in, they're like, hey, markets are up. Your instinct is not going to be to believe that. But that's what we've had for this inflation stuff now for 5-6 straight years, which is that we're all doomed. We're all going to get crushed by inflation. Everything is terrible. Then this number has been coming. We called it last month that was going to be the high water mark, that it couldn't be sustained for that long, especially with oil prices coming down. It shocks me not at all that we came in significantly below expectations on inflation, but People can't believe it. And the biggest piece of that is not even the oil, it's the housing.
Yep.
And people cannot wrap their minds around that.
I always feel like, too, in terms of rate reaction to news, it's a little bit like you host a cookout, you put out a bunch of food. You're like, hey, should we do more burgers, more hot dogs? What's the good mix? Well, if you take a reading of it just immediately, there's somebody that's just hungry, and they probably got a little bit of both. And so you see a little bit of a market reaction, but you'd be foolish to draw an interpretation of that. I always feel like sometimes on this type of news, hey, like, where are we at the end of the day? When I survey the buffet line at the end, what was actually consumed? What was the narrative that the market is actually now taking root in? And it doesn't always happen in the first 30 minutes. Sometimes it takes a little time.
Yeah, this is the time when we look at the buffet and we thought, how are there 6 hot dogs but no potato salad?
Yeah. I'm waiting till
who ate all the potato salad?
I'm waiting
and
for
why?
that to come out.
Yeah. So.
Yeah. All right, we'll wrap it up there. Y'all have a great day. Talk to you soon.